Hello, I'm Ginger Chan, founder of WealthQuant. If you've experienced a high income year, a major liquidity event, or you're facing a significant upcoming tax liability, one strategy worth serious consideration is the Charitable Lead Annuity Trust, commonly known as a CLAT. A CLAT is a sophisticated planning tool that can help you meaningfully reduce taxes today, support charitable organizations in a structured and intentional way, and still preserve or even enhance long-term wealth for you or your family. And for the right individual, it can serve as both a powerful income tax strategy and an elegant estate planning solution. So in this video, we'll walk through what a CLAT is, how it works, the key benefits, the risks and the limitations you should understand, common scenarios where it makes sense, and how our team works alongside CPAs and estate planning attorneys to help clients structure these properly. Before we continue, a quick clarification. This session is for educational purposes only. Nothing discussed here is tax, legal, or investment advice. At WealthQuant, we do not provide tax or investment advice. We design and evaluate strategies. We perform modeling and analysis, and we coordinate with licensed professionals such as CPAs attorneys for verification and execution. So all examples shared in this presentation are for illustration purposes only, and the actual outcomes will depend on individual circumstances, eligibility, timing, structure, and applicable tax law at that time. So what exactly is the Charitable Lead Annuity Trust, or CLAT? Well, it's one of the two main types of charitable lead trusts. At its core, a charitable lead trust is a structure where the charity is named as the first beneficiary. And a non-charitable beneficiary, such as the donor, their children, their nieces, nephews, or other family members, ultimately receives what remains after the trust's term ends. And what makes a CLAT unique is the A in its name. It stands for annuity, and that means the charity receives a fixed annual payment every single year for a set period of time. And this period is often designed to last anywhere from 20 to 30 years, but the duration can be customized. CLATs are popular among affluent families because they let you do a few things. You can support charitable organizations, you can take advantage of significant tax benefits, and you can still preserve wealth for yourself or your family in a very strategic way. So they tend to appeal most to people who are charitably inclined, are looking for a substantial income tax deduction, and want to pass wealth to the next generation in a tax-efficient manner. In other words, a CLAT works both as an income tax strategy and as an estate planning strategy at the same. So how exactly do CLATs work? Well, first, you need to contribute the assets into the trust. So you establish the trust and you fund it with assets of your choice. A CLAT can accept nearly any type of assets, including cash, public or private equities, real estate, or even crypto. And throughout the trust term, the assets can continue to be managed and reinvested just like a normal investment portfolio. When you create the CLAT, you may receive an immediate charitable income tax deduction, potentially up to 100% of the value of the assets contributed, depending on the structure and assumptions. This matters because it can significantly reduce taxes in a high income tax year. For example, if you realize $1 million of gain, your tax bill could range from roughly $238K to $528K, depending on the income type and the state of residence. A CLAT can reduce that burden by as much as 60%, and any unused deduction in the first year can generally be carried forward for up to 5 additional years. The trust's investments can mirror the same exact strategy that you would otherwise pursue in a taxable investment account. The only difference is now that those investments are housed inside a structure that's designed to optimize both philanthropy and for tax efficiency. So each year, the charity that you select receives a fixed annuity payment from the trust. Most CLATs are designed to be tax efficient, which means distributions are often backloaded, which means it's very small in the early years and it gets larger toward the end of the trust term. So when a trust term ends, which may be set for a number of years or even your lifetime, whatever remains in the trust goes to the non-charitable beneficiary, either you or your chosen heirs, often in very tax-advantaged ways. So taxation inside a CLAT follows realization rules, which means taxes generally are only due when income is actually realized inside a trust, not simply as assets appreciate. In essence, a CLAT allows you to support meaningful charitable causes, reduce taxes in a powerful and immediate way, allows you to continue investing like normal, and ultimately redirect the remaining wealth back to yourself or the next generation, turning a tax obligation into a strategic and purpose-driven plan. So there are two primary tax advantages with CLATs. The first one is upfront income tax deduction. You can write off already realized income that would be taxed at a high tax rate, such as ordinary income or short-term capital gains, and reinvest what would otherwise be taxed. So the deduction in year one can be as high as 100% of the amount contributed to the CLAT. The charitable deductions are capped at 60% of adjusted gross income for cash gifts and capped at 30% of adjusted gross income for non-cash gifts. But any unused charitable deductions can be carried forward for up to 5 additional years. The second tax benefit is estate and gift tax savings, which is powerful for legacy planning. In 2025, the lifetime gift and estate tax exemption is $13.99 million per individual and $27.98 million for married couple. But by giving to a CLAT, a donor can transfer wealth to a loved one without using up any lifetime exemption. And at the end of the CLAT term, the remaining principal, potentially a very high amount, have the potential to pass free of gift tax to the beneficiaries. So now that we talked about what CLATs are and their tax benefits, we should also talk about the risks and the complexities involved. There is a liquidity trade-off in this strategy. The money inside a CLAT is locked away for the entirety of the trust's term, much like a retirement savings account or IRA. That said, the donor can direct the trust investments during that time. So the donor still has control over the investment outcomes, and the donor can choose the trust term. Typically, people set up these structures for a minimum of 15 years as the benefits compound and significantly increase beyond this length. Also, remember, this is an irrevocable trust, which means that a gift to a CLAT becomes irrevocable. So you can't claw it back once you gift it in. Once it's gone, it's gone. So by making a gift to a CLAT, you're making a substantial charitable commitment. So it's important not to set up a CLAT unless you're serious about supporting charity. And in many cases, while gifting to a CLAT will be more tax efficient than gifting directly to a public charity or gifting to a donor advised fund or private foundation, you will still be worse off, personally, than if you hadn't made the charitable gift to begin with. The charity will be better off. So now that we talked about the risks and the benefits, we can go into a real life example. So Zach is a Manhattan attorney who jumped into crypto a few years ago and did really well. So this year, he decided to cash out about $300,000 in gains. What he didn't realize is that most of those gains are counted as short-term capital gains, which are taxed like regular income. So when he stacked that on top of his $500K W-2 salary, he's suddenly staring at a tax bill of almost $400K for the year. That really hurts. But Zach has another option. He can use a Charitable Lead Annuity Trust, or CLAT. And here's what that means in practical terms. By funding a CLAT, Zach may be able to take a large charitable income tax deduction based on the design of the trust. And in this example, about $300,000 which could save him about $150K in taxes this year. So he gets to meaningfully support a charity that he truly cares about. And because he names himself as the remainder beneficiary, any investment growth inside the trust above the IRS assumed rate, which is around 4% IRR in this example, can eventually come back to him. So what does that actually look like over time? Well, if the trust run for 25 years, and the investments average around 8% growth, the CLAT could generate roughly $1.3 million in total payouts. And about $360,000 would go to the charity, which is the intentional trade-off he agreed to. And Zach would still walk away with approximately $971,000 for himself. So if we compare that to the alternative, which is if Zach just simply paid his full tax bill and reinvested what was left, which is about $150K, into a normal taxable investment account, after taxes, he'd likely end up with closer to 761K instead of 971K. In other words, the CLAT lets him reduce his current tax burden, and it allows him to support a cause he believed in and still potentially come out ahead financially over time. So at the end of the day, CLATs aren't just about lowering taxes. They're about designing outcomes, aligning philanthropy, tax efficiency, and long-term family wealth in a way that feels intentional, strategic, and meaningful. They're powerful when structured well, and they're elegant when matched to the right client. So if you're facing a high income year, large capital gains, or you simply want to turn taxes into purpose while still building wealth, a CLAT may be worth exploring. At WealthQuant, we don't do this in a vacuum. We work directly with trusted CPAs and estate planning attorneys to model outcomes, structure the trust correctly, and ensure everything's done thoughtfully, legally, and in your best interest. So if you'd like to learn more about the strategy, book a discovery call with us and we'll help you understand whether CLAT is right for you or whether another strategy may be a better fit. Thank you.